Good morning friends, welcome to The Point. In this video we will understand a financial instrument known by the name of derivatives. So we'll start what is the meaning. So I'll first explain an example which will make it easier for you to understand what derivatives is. So every one of us consumes sugar, isn't it? And from where do we derive sugar? It is the sugar cane from where we derive sugar. So now if you see, the price of sugar is dependent on what is the price of sugar cane. So definitely it is not the case that in case if the sugar cane prices changes by 2 rupees, so the sugar will also change by 2 rupees. But yeah, certainly in the long run, if the sugar cane is getting expensive or cheaper, it will definitely have an impact over the price of sugar sold in the market. So if we see, the crux of the story is that the sugar derives its price from the sugar cane. So what is the term that I use? That sugar derives its price from sugar canes. So is the case of derivatives. Derivatives is a financial instrument. In this case, this product is deriving its price from sugarcane. So derivatives is a financial instrument. Now this financial instrument derives its price from the underlying asset. So let's suppose if we assume sugar is the financial instrument and the underlying asset is sugarcane. Now this financial instrument is deriving its price from the underlying asset, which is sugarcane. So in case of financial instruments, underlying assets could be bonds, currencies, interest rates. So yeah, we will study in the upcoming slides, but as of now these are called the underlying assets and these could be the one. Originally, underlying corpus is first created, which can consist of one security or a combination of different securities. Now what it says is that the price of this financial instrument can actually depend on one security or a combination of different or bunch or more of one particular security. So that is not an issue, but what you have to understand is there is some underlying asset through which this financial instrument derives its price, which I have explained with this sugar and sugarcane example. The value of derivative is bound to change as the value of underlying assets keep changing continuously. If this keep changing, then definitely it has an impact on this sugar's price also. Now moving on to the next slide, which shows what are the underlying assets in case of derivatives. It could be bonds. So if I say my financial instrument is dependent on the underlying asset, which is bond, so whenever the price of this bond changes, the price of my derivative, that is the financial instrument, also changes. In this, it could be commodity also, indexes, which is BSC, NSE, and currencies. Currencies is like dollar, yen, pound. So whatever my financial instrument is relying on, and whenever its price changes, it will change my derivatives price also. So these are the commonly accepted underlying assets which prevails in the market. Next is types of derivatives. First is futures and forward. A forward contract is a customized contract between two parties where settlement takes place on a specific date in the future at a pre-agreed price. Now these futures contract are special types of forward contracts in the sense that the former are standardized as they are traded on stock exchange. So first let us understand what is this forwards is all about. So let's suppose Mr. X is there, Mr. Y is there. Okay, now Mr. X and Y has decided that on 25th of next month, which is let's suppose April, on 25th of April, X will give a piece of land which X holds at 1 lakh rupees to Mr. Y. Yeah, so what X is doing, it is deciding the price in advance, deciding the date in advance, and deciding the person to whom it will hand over Now, irrespective of whatever the price is of this piece of land on 25th April, it could go to let's say 2 lakh also, or it could be at the 50,000 also. But since X has promised that I will give you this land at the rate 1 rupees 1 lakh on 25th April, so this person has to is obligated to give this to Mr. Y. So basically, forwards is a contract whereby two parties come in and decide to execute a contract on a pre-agreed price. Fine. In this case, which X and Y did, no matter whatever is the market price of the property or the underlying asset, it really doesn't matter. All it depends is the pre-agreed price. Now what happens is, now these contracts are traded on the stock exchanges, but the forwards is the one, the futures are the one which is traded on stock exchange, and they are standardized, which means that there is an intermediary in case the one party defaults, which would help in the execution of contract. Now these forwards are the ones which are not traded on stock exchange, and hence they are not standardized, but both of them are almost the same, where both party comes in and decides to execute a contract on a pre-agreed price at a preset date. So this is about futures and forwards. Now comes the options. So these are the types of derivatives. Okay, next is the options. Options are two types: calls and puts. Call gives the buyer the right but not the obligation to buy a quantity of the underlying asset at a given price on or before given future date. So we will understand like this way. For an example, there is a movie which is getting released on Friday. Okay, and X has already got the ticket for this movie. Okay, and now comes in Y. So Y says, I will buy the ticket from you, dear X, deciding if the movie is a hit or not. I will decide on Friday after it is released. So Friday comes and see Y notices that the movie is not a hit and it has flopped badly. So now the Y has an option that it can either purchase the ticket or can deny from purchasing it. So what has Y got? He has got the right either to buy or not to buy the ticket. He is under no obligation that he has to buy the ticket. Y has the right to decide that whether he wants to buy the ticket or not. Let's suppose if so I'll put it this way. So it was Friday. I mean, the X has got the ticket before Friday for rupees 50, and Y has got the right to buy the ticket depending on whether the movie is a hit or not. So Y will decide it on Friday. Now let's suppose the movie is a hit, okay, and the price of this 50 rupees ticket has gone up to 100. Yeah, so X will not get the price of 100 because Y has already the right that it will buy the ticket at rupees 50 if the movie is a hit. What if the movie is a flop? Then this price will fall up to 30. So Y on Friday gets to know that movie is a flop. So now Y will not exercise his right of buying the ticket. Only a certain amount of premium will be paid. Let's suppose it was decided that 3 rupees is a premium that was decided to enter into a contract, right? So Y getting to know that the movie is a flop will not buy the movie ticket at rupees 50, which they decided. The only loss which Y suffered in case the movie is a flop is rupees 3, and in case if movie is a hit, so the ticket is around rupees 100, but Y has got a profit of rupees 50 because now he will exercise the right that he will take the ticket at rupees 50 only from X. So here in this case X is at the loss. So this is the call option. Now we will understand what is a put option. So okay, call gives you right to buy. In case of put option, you get the right to sell. Okay, I'll again take that example. Friday is the day when the movie is gonna release. X is getting the ticket at rupees 50 on Monday. He has already got the ticket in advance. Now this time X has got put, that is right to sell. Now X and Y are in the contract that X will sell the ticket to Y on Friday, seeing that whatever is the case, if the movie is a hit or not. Now the Friday comes and movie is a hit. Okay, but the X has decided that it will give a ticket at the rate rupees 50. Okay, but also he has got a put option where he has got right to sell. In case if the movie is hit, X will not sell this ticket to Y and will cancel the contract and will sell this ticket in the open market for whatsoever amount he fetches for it. Let's suppose 150. So here X has an option. This depending upon the situation on Friday, the X will decide whether he will sell the ticket or he will not sell the ticket. So in case of put option, you get right to sell. It is on you whether you want to sell it or you don't want to sell it. It is not an obligation, that is you are at a free will to sell it or not. In case of an option, you have a free will in case whether you want to buy it or not. There is no obligation under call and put. You just get the right of buying or selling. So this is what call and put is. The last derivatives is swaps. So what is swaps? Swaps itself means is exchange. Now in this case, we usually tend to exchange our cash flows. The two parties decides that we will exchange the cash flows or the interest payments or the currency rates between the two parties. So these are the basic three types of derivatives. First is futures and forwards. Forwards is not regulated one, futures is. The other one is options, which is call and put, which gives you right and to buy and sell. And third one is swaps, where you are exchanging your cash flow with the other party. So now where are these traded? Trading of derivatives takes place at NSE, BSC and at multi-commodity exchanges. There are other exchanges as well where the trading of derivatives takes place, but these are the three major ones where the trading of derivatives takes place. So I know this is a bit a typical topic and it will take you a revision of 1 or 2 times to sink in what derivatives are. So I would really request you to go through the slides once again and to go through the examples first in order to understand. The first example was sugarcane and sugar. So that will help you in understanding the mechanism of derivatives. The next example was of X and Y getting into a contract that they will sell the property on so and so date. Fine, X and Y example. The next example was of the movie ticket, where X and Y respectively gets the right to buy and the right to sell. So just remember that example of movie ticket. If the movie is a hit, then how the X will behave and how Y will behave. So this movie example you should again read. And the last one was exchanging of the cash flows. So this is all for the today's video. Thank you so much.